Look around your neighborhood. You likely think you own your slice of the North American dream, but you don't. Behind closed doors, a silent wealth transfer is dismantling that ownership, moving physical property into the hands of shadow corporations. Welcome back to Capital Casualty. Before we examine this strategy, remember, this information is for educational purposes, not financial advice. While the public remains distracted by daily political theater, legacy capital has pivoted to a different kind of market takeover. This data shows the scale of the threat. Families are being systematically outbid by multi-billion-dollar firms, providing all-cash offers 20 to 30% above market value. When cash bids consistently outpace local savings, the housing market shifts away from individual owners and toward high-yield institutional acquisition. Old money families have moved past building new products. Their 21st century strategy focuses on monopolizing the necessities of life, starting with where you live. To fund this, they utilize massive credit lines secured at near-zero interest rates to buy up existing homes. Their goal is to capture generational yield, a permanent revenue stream created by converting traditional homeownership into a monthly subscription service. While anti-monopoly laws are designed to prevent this scale of control, these entities use a specific loophole in corporate law to evade government oversight. This diagram shows the mechanics of the loophole. A single conglomerate divides its holdings into thousands of decentralized shell LLCs to hide the true scale of its empire. By fracturing their assets across thousands of different legal names, these firms ensure that regulators never see the full scope of the monopoly. We can track the immediate mathematical impact of this strategy by looking at the neighborhood level. The rent you pay no longer cycles through local businesses. The economic loop breaks, pulling currency away. It's siphoned into offshore accounts, paying dividends to family trusts owning the debt. This capital flight drains the community of disposable income necessary to sustain itself. As residents spend more on rent and less at local shops, those small businesses begin to fail. The shadow corporations then return to the neighborhood to buy the distressed commercial real estate at a fraction of its original cost. Extracting wealth through rent while simultaneously acquiring collapsed commercial space consolidates the ownership of a town's physical infrastructure into a single distant network. On a global scale, these interconnected asset management nodes represent a concentration of wealth that often exceeds the GDP of entire nations. The result is a landscape where capital is constantly removed from local towns, leaving behind a permanent renter class. For the individual investor, this confirms that the era of simple ownership is facing a highly coordinated, systemic challenge. Survival in this market requires the agility to spot macro trends and the knowledge to see through the shell companies. Without understanding who the real players are, the individual investor becomes the product being harvested. This trend raises a difficult question. Are we seeing the final days of personal ownership, or a future where every necessity is managed by offshore trusts? To monitor these shifts in ownership before they reach your local market, the traditional path to building wealth through home equity has been shattered by a new type of corporate buyer. Families entering the market are consistently outbid by all-cash offers that materialize in hours, long before a standard mortgage can be approved. These acquisitions drain the local inventory, leaving residents with no choice but to rent the very homes they intended to buy, often at a significant markup. This suburban model once relied on a local ecosystem, where housing costs were tied to what people in those specific communities actually earned. Today, the rising cost of acquisition and the removal of physical inventory have made the goal of owning a home an impossible mathematical equation for the average citizen. The concept of a local housing market has become a fiction. The neighborhood is now just one piece of a global dataset. Public attention often settles on the aggressive corporate landlords who use thousands of shadow LLCs to purchase these properties. These shell companies work in the background to consolidate thousands of single-family homes into massive, centralized portfolios. While this consolidation is disruptive, it is only the first phase of the wealth extraction process. For modern institutional capital, the simple act of collecting monthly rent from a physical tenant is too slow and operationally inefficient. The real profit engine only activates once those homes are converted from physical shelters into financial products. Phase 2 is driven by single-family rental securitization, a complex process that turns your monthly rent check into a globally traded asset. Wall Street bundles the expected income from thousands of properties into a single pool of cash flow. This pool backs newly minted bonds, transforming neighborhood survival into a tradable security. These rental-backed bonds are then sold to global investors and sovereign wealth funds. By converting physical shelter into a speculative derivative, Wall Street has successfully financialized the basic requirement of human survival. This shift moves the center of control away from local neighborhoods and into the institutions of Wall Street. Within these trading floors, the primary focus is satisfying the mandatory yield requirements of distant bondholders. This creates a total disconnect. Your local rent is no longer dictated by local wages, but by the performance targets of a global security. If a hedge fund requires a 7% return this quarter, the algorithm dictates that local rent must spike by 15% to cover that yield, regardless of the tenant's ability to pay. Corporate landlords are legally bound to maximize these profits to satisfy the security, making individual negotiation or leniency impossible. The result is a persistent economic squeeze that funnels local wealth into the accounts of global asset managers. As single-family homes are permanently absorbed into these corporate portfolios, the middle class is forced into a subscription-based lifestyle. The equity that families once used to fund retirements or education is now captured by the bondholders, leaving the resident to pay a premium for an asset they can never own. The gap between stagnant local wages and the yield-driven price of housing creates a mathematical barrier that prevents the average citizen from building wealth. This structural shift toward corporate feudalism replaces the traditional model of home ownership with a system of permanent extraction. How can an individual survive in a market where local housing is dictated by global algorithms? Success in this environment requires moving away from traditional real estate rules, as no family can outbid an all-cash corporate algorithm. Building wealth now requires a focus on decentralized assets and high-income digital skills that aren't tied to a single geographic location or traditional mortgage. Understanding these macroeconomic forces is the first step to protecting your capital. Subscribe to Capital Casualty and turn on notifications to see what the market rarely shows you.